All right, welcome back. What I want to do is this is being filmed on January 2nd, so Happy New Year to everybody. And I wanted to start out, this is going to be my first video on the channel, kind of going over what my outlook is and my strategy is for trading options during the year. If you don't know me, obviously that's not a surprise because I haven't really posted. I don't post on the internet. I'm not a social media person or a marketer. I am a CFA charter holder. My name is Ben Collins, and I am the founder and chief investment officer at Options Autopilot. I'm just a market enthusiast in general, and I basically wanted to go over what my strategy is going to be for 2025. It's going to be not super different than what I was doing in 2024, but it's going to be more automated, obviously using Options Autopilot and also doing a few more asset classes. So if you want to follow along with the journey, I'm going to be posting results, so make sure to subscribe and like and share it with someone else who is wanting to trade options or potentially automate their option strategies. So I just want to show this journey and basically be totally transparent with profits, losses, lessons. I used to have a blog back in the day, back in 2008 even, but this is kind of the new blog, but I've never been a filmer. But anyways, that's besides the point. Let's kind of just dive into what I'm seeing. Again, this is obviously not financial advice. This is just my opinion. Take it for what you want. Don't follow it. This is just what I'm doing with my capital. I'm not suggesting that you should do that with yours. So where are we at? Obviously, we're close to near all-time highs, but we've definitely pulled back. This is the S&P 500 futures. As an aside, I'm mostly going to be talking about trading options on futures. That's currently mostly only available on Tasty Trade. Schwab is supposedly working on it, but if you're wondering why I'm looking at all the futures, that's why. There's a little bit of benefits, which you can find over on optionsautopilot.com. I have a course basically for free talking about why options on futures and just how to learn them if you have never traded them before. But obviously we had Trump get elected in the end of 2024, and it's crazy to think it's already 2025. A lot of I think good news was getting priced in anticipation of him taking office. So I'll be curious to see what happens with the market. Obviously nobody knows what's going to happen, including myself. In terms of valuations, I mean, you could have some expansion. We'll see. I think I'm a little bit cautious right now. A lot of people will say, as January goes, so goes the market. So if you have a negative return in January, a lot of people, I have to look at the statistics. A lot of people will say that you end the year down. I don't know how reliable that indication is, but obviously you can see we hit a high 61.63 back on December 16th. And since then we've kind of trended sideways to down. I don't know if the uptrend is still intact in reality. I think it's arguable. That's where I'm a little bit cautious here in general to see this. I mean, this is kind of starting to look like if not a double top, or maybe the start of a head and shoulders pattern. But the trend has been up very strongly since the middle of the year. I mean, I guess the whole year, you could argue. But as we kind of zoom in, you can kind of see it's starting to break here. So I'm not necessarily trading directional. A lot of these positions are going to be mostly market neutral, slightly bullish, because the market does typically go up over time. But I think we could see a decent pullback as people kind of look for value, look for what's the new administration going to do this year. A lot of people are thinking it's going to be positive for small businesses. That's what we saw the Russell rally quite a bit after lagging for quite a while. So that could still be a decent trend depending on what happens. But a lot of stuff gets said by both sides. So this is not to support one versus the other, but a lot of stuff gets said by politicians in general. And They don't always follow through, but hopefully for the people that can benefit from small business new legislation, that could be a good thing. So we'll see what happens there. Probably makes sense to be long Tesla, even though I think, again, a lot of the benefit has probably gotten priced in. They missed their deliveries today. I think it was today, their deliveries numbers. So in general, when I do these updates, I'm probably not going to fully go through individual names, but since it's relevant, I figured I'd pull up some of these. No, it's not alcohol. It's just a bubbly soda. Okay, so where's Tesla? Yeah, so if we're looking at Tesla, definitely pulling back, but I would again argue that we've got maybe a double top here. Wish I could make this look a little bit better, but I would say that this is definitely looking like a double top scenario, fairly obviously. So I would be looking for more downside on this, even now, just because I think that the optimism is probably out for the time being. Obviously, the other stock that led the way in 2024, Nvidia, was up today. I do think that that's also looking and has looked like it topped. Let's go out to the 1-year chart. Well, I don't know if it's top, but yeah, it definitely broke this uptrend back here, and it's mostly just trended sideways. So it's looking kind of heavy. If it can recapture this level, then maybe there is more upside. Basically, if you're going to take a bearish position, I'd say if I'd have a stop at a new high, for anyone looking to do that. It might make sense actually to do a strangle at this point while things get figured out, but I think it's more likely that the trend is flat to lower than up, as the market digests, but just a guess. Let's look at crude oil, and this is one of, I guess I might as well kind of go over what my plan is, and I'm going to try and make this kind of simple. It's going to be automated with options autopilot, so I don't have to do anything. But if there's anyone that's trading this manually, I think the most simple way is to just do these every 2 weeks if you have the capital to put them on. So let me pull up my spreadsheet here, and let's go over like what my plan is. So I actually really like the 111, as people will call it. I think Tom King is claiming he coined that phrase. That's possible. I don't recall. I just know that it became a lot more popular, and I came across his videos. I think he's done a decent job in educating. I don't think he's always very transparent on when he's taking losses. Volmageddon really took him out. He didn't really admit that until later, but in general, I think he's trying to do a good job, so I'm not trying to rag on him. I think he puts out a lot of good content that's educational, and he is trying to help people with risk management. So that's all good. That's all we can hope for when we do this, is just risk management is the key to staying alive and trading. So I think the 111 is the most flexible. And again, if you don't know what the 111 is, I do have other videos on this. Go look them up, or I have a course on options autopilot that is free. You can watch that video. And basically it is a long put spread and a short naked put. If you're new to options, I would, again, go to options autopilot and do the course. Let's make this 2025 plan. That will kind of explain a lot more of what I'm talking about, but I'm not going to dive into that here. I'm going to assume you know what I'm talking about. And similar to, I guess, the similar vein that Tom King does, he does go over a lot of different asset classes. I think this is a good reason why I've never seen him show this. Maybe he has, but this is how I approach it, and why I do think it is a good way to trade options in general, is to look at the cross asset correlation. And basically in 2024, I was mainly trading ES, S&P 500 futures or MES, depending on, how much exposure I wanted and dollars at risk. And moving forward, I'm still going to trade those. I'm going to be integrating gold, oil, the 30-year bond futures, and then I don't really have access to Bitcoin futures options at this point. If someone knows where to be able to trade them from the major brokerages, let me know down in the comments. I would be curious because we definitely want to add that into options autopilot. But for now, I'm going to use the most liquid kind of ETF available. And then finally, I'm going to do some 0DTE on SPX. So these are going to be the approximate percentages that I'm targeting. To keep in mind that this is 100%. I better double check this before I actually say that. It is not 100%. I'm going to say SPX is going to, 0DT is going to be 10%. So I'll adjust that. Because realistically, these are all S&P 500, right? But I want, for the most part, the longer term strategy to kind of complement or cover losses on the 0DTE. I'm going to do another video on 0DT and what I think people need to be aware of. It's kind of all the rage right now and the craze. Everyone's talking about how you can just make all this money. That usually would indicate that a lot of people are going to flock to it, and then you can't really make all this money anymore. But in general, options do have structural inefficiencies that you can exploit. And if for some reason there's a streak of, options that get underpriced, then the market will correct and eventually it should be overpriced again, just like typical insurance. But that's not really the focus. The ability for me to put these on systematically and automatically with our platform, Options Autopilot, I think is going to be the key to success in the long run. And the reason I like the one-on-one is it uses a reasonable amount of margin in general. And it's just kind of good for situations where, let's say the market does kind of trend down, but it's not super quick. I think we could get kind of not a plunge. We could get a decent pullback because I think the market's going to look for value. And the market is going to probably start to psychologically view something as cheaper or some type of value around 10 to 15% drawdown. I've heard that from multiple people. Typically when you're doing these one-on-ones, and I should clarify, I'm doing what, again, some people have called the long-term one-on-one. I'm doing over 100 days to expiration positions. And the reason I'm doing that is better return on margin because it requires less margin to put those on. So if you do that, let's just label this long-term 111. If you're doing that, then you typically have about a 15% drop that can be sustained before you're outside your bear trap, it's called. Actually might even have a 111 up on SP or on Thinkorswim. Let's go to my risk tab. Let's pull up ES. I think I had some 112 that I was talking about earlier on a video. So you have to bear with me. I'm not a YouTuber at this point. So this is a 112. Let me just adjust this and we'll easily make this a 111. But this is 105 days to expiration, and we'll just adjust this. Apparently I need a new laptop because it can't handle all this stuff now. Okay, so there we go. Now we got the one-on-one. Here's the potential profit target, 637.50. So that's the estimated that's the max credit on the upside, of course. But you can see here that the bear trap, obviously, you can make a significant multiple of your money if the market pulls back in a kind of slower manner, right? So on options autopilot, we obviously preset our take profit and our stop losses and then our time stop. So that's all set for you, and it's just managing the trade based on those parameters. If it gets into the bear trap area and you haven't hit your stop loss, it will turn off your take profit, and you will basically be able to potentially get this 5650 is possible. It does keep your stop loss on if the market starts to accelerate, of course. But you can see here that this is, current market. This is 10% down. We have about a 15% drop, and this is just right now where VIX is at. Obviously, VIX is not going to stay static, but it is potential to increase, decrease. So we just got to keep that in mind when we're looking at margin requirements and also our Vega exposure. Like what comes to mind is obviously a couple weeks ago when we had even just a 15% spike, let alone the Volmageddon scenario in August, I believe, where it just massively rallied and took out people. And you definitely need to be aware of that. That's why I would go across asset classes like this. But so this is kind of the idea of what I'm going to be doing consistently. I'm going to be using options autopilot to just do this on a weekly basis. If someone's doing this manually and you want to follow along, again, do it at your own risk. This is not advice, but I would just make it easy and do it every 2 weeks. That just kind of helps with if there is a drawdown in the market, then you can basically kind of sit it out automatically, and it's a little bit easier. We've already had a decent amount of pullback from the top. There's an indicator that we have that if it extends too far, it will reduce or close positions once it triggers that. But you can kind of see it technically would have been close to triggering there, but it didn't finish outside and then come back down. But in general, you can kind of see, okay, let's say it triggered here. You have about a couple week cool off period. Now, in my opinion, you get some spikes in the meantime, and you kind of lose out on maybe making some income. But it's just a matter of kind of survival and wanting to live to trade another day. But in general, that is the plan for me, to just do 111s on a bunch of different instruments. Let's pull up crude oil. You could do this on the ETFs. I have in that spreadsheet the equivalent ETFs if you would like to use that. You don't get the same margin benefit if you have a margin account. I would say on oil, and one of the reasons I think it is beneficial, because you could have the market kind of coming down, and we've got a little bit of geopolitical issues happening at the moment. I would say that crude oil is looking more bullish from this standpoint, in terms of kind of had a little bit of a base for a few months, and it's kind of breaking that base to the upside. So I would say it makes sense to be doing the 111s, which are, again, slightly directionally long by a few deltas. But it's also, I would say, with geopolitical risk and the stuff that's happening right now, you're more likely to get spikes to the upside. That's why I don't particularly like selling strangles on crude oil. I'm sure they can be managed, and over time options have to be priced correctly / overpriced, so it should work. I would just rather do the 111s. I mean, imagine if you were doing that all along here. I think it would have worked out pretty well. Even, these would have been kind of fast moves. You probably would have taken some losses, but that's why you have to stay consistent, and why it's a benefit to automate this stuff. So then you don't even have to think about it. It just takes it off, puts it back on. Also going to do gold. Let's pull up gold futures. Again, we saw a crazy rally this year. It's kind of cooling off. I'll be curious to see what happens from here, especially with Bitcoin getting a bid as well. Maybe there will be a decent correlation. I mean, not that there was on that asset class. We'll look at it in a second. But again, a diversifier should hopefully trade somewhat uncorrelated with other risk assets and the market. But that is, oops, let's pull up the 30-year treasury. So we can see that yields have been obviously moving higher. The market seems to think that the policies of the Trump administration likely going to be the Trump and Elon Musk administration are likely to be maybe inflationary, or they don't think it's going to be as under control as people think. So yields are going up again. So that's something to watch. Obviously, the market likes certainty, and it likes when there's a kind of dovish Fed and they are lowering rates, but they might not actually be able to lower rates as much as they've thought so far. So that's something to watch. This is trading towards the lower end of the range, but that doesn't mean that it can't go lower. So definitely never bet on that. But I think because it is in at the bottom end of this range, I think it would make sense to, again, do the one-on-ones. Let's go like way out. Yeah. I mean, obviously you're still a ways away from this, but I just think it's a good time for the 1-1-1 strategy. I think it's a pretty versatile strategy. And again, if you automate it, it'll just work for you, basically. You can get the benefit if you get the multiple, of the credit, or you just get the credit and it just keeps working. Let's see, where is the actual, volatility on bonds in general is not very high. Looks like it only ever really got to 20% in the past 3 years, but that's just basically how I'm planning to structure it. Let me pull up that matrix again. So in general, I'm trying to be, basically it's about a third of the portfolio is going to be, the index. Like I said, the 0 DTE is going to be 10%. And the reason I'm doing that is just, I guess account size, and I kind of want to keep it limited to where, I guess I should clarify, that's 10% based on margin. So I'm going to do a max of probably 50% margin. This will vary based on volatility levels and what I think is reasonable. I guess based on where the current VIX is, we're close to average, 1793. 20 is theoretically long-term average. I think we could get more spikes like this and this. Let's pull up the 1 year. So this is what I was talking about, where you got like a 15% spike or 15-point spike in the VIX. I think you need to be careful on that. That's probably going to happen more often, just going forward with a lot of people doing short volatility trades. So you definitely want to keep things managed, but that's again why you probably want to go across asset classes. Some things will have higher correlation when they fall. It's called crash beta. I need to find a good reliable source of crash beta, and maybe I could throw that into here. But as you can see, gold to crude oil, 0.22 correlation, gold to S&P, 0.16. So ultimately, a lot of these should be pretty good in terms of diversification for the portfolio. And that is what they'll say, the only free lunch in the game. And what my goal is with, the 0 DTE, you get a little bit of incremental, return. Hopefully it's a ability to put on a lot more trades. I'm just curious because I've done a few, but I really want to do it consistently and just see in reality, can you make that much money? I'd probably do iron condors on 0 DTE would be my guess. but I am curious to do the 111s because as we know, you kind of take the escalator up and the elevator down, as the saying goes. And I think that that would be the case on a daily basis. So stuff's most likely going to go to the downside, but I don't know if the options are priced favorably to do that. The volatility on 0DT stuff is just very depressed because, excuse me, if people are selling these on a daily basis, it's always just going to suppress the volatility itself. So I want any kind of drawdown from 0DTE to kind of get offset by the more predictable, longer term, hopefully returns of the index, the long term 111. So my goal is to, let's say if we're doing SPX, I think that you could probably have a $1,500 position on a iron condor, right? And you're probably going to make, let's say 20% on that. So $300. So if I'm basically gonna, but your loss is gonna be double. So if it's like $600 to $700 loss, I definitely would want one of my 112s to potentially be, making me $600 to $700 on any given one, especially if we're doing them on a couple week basis. So that's kind of how I'm thinking about it and approaching it. I will probably stagger, all these exposures as well from a time standpoint. I would say actually based on the graphs, the charts, I would potentially put one position on all of these at once because it seems like a reasonable time to do it. But in general, I'll be staggering these and have a few on at once. Here's the ETF version I was saying. If you want to do that, or if you have to do defined risk, or you don't necessarily have futures availability, you could definitely use these to do the same thing. There is another site, I need to find it, where you can put in specific tickers. So you could even test this against each other. It should be pretty similar to these, but obviously it's not exactly the same. So it'd be good to test that, and I'll find that for a future video when we're looking at that. But that is my plan. My goal is to earn anywhere from 2 to 4%. This is a taxable account, it's not a retirement account. So my goal is to earn 2 to 4% per month. That would be on margin, not on the actual account itself. No, I take that back. It would be on the account itself, earning 2 to 4% on the actual account value, which might be a little bit higher based on the margin, but we will see. Stay tuned. Share with someone that maybe wants to follow along and can appreciate a nerdy guy that's trying to show what he's doing with trading, and we will see how Options Autopilot performs. If you want to get the kind of trade plan I have for the 111, the 112, and like 0DTE, I have that in a PDF. You can download that below, and come check out Options Autopilot and see if that could maybe be a helpful tool for your trading. I know it's helped mine. That was the whole reason I built it, because I work all the time. I don't have time to monitor, and it's actually probably better to not monitor because we psychologically do the wrong thing at the wrong time. And I definitely know from my own experience when we're even testing this, I would kind of just be obviously putting on different ones just to test the system out, and also kind of interfering at times, and it would have worked out even better had I not touched anything. So it's just proving the validity of just kind of a systematic, automated strategy. So thanks for watching. Appreciate it. And stay tuned for more updates like this, and hopefully profits, but if losses, you'll see them as well, and we'll definitely learn from them, and we'll see how the year goes. Take care.